Good morning, everybody.
Sorry, Peter. Yeah, no problem at all. Good morning. Good morning, ladies and gentlemen. Welcome to the SURESERVE Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab that's situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, I'm sure that would be received well by the company. And I'd now like to hand over to CEO Peter Smith. Good morning.
Good morning, Mark, and thank you very much. Thank you, everyone, for joining. As many of you will know, this is the first time we've used Investor Meet Company, so an exciting development for the SURESERVE Group to look to do this, and very keen to see the questions that come up and obviously see the subsequent feedback. So just to make introductions first, I'm Peter Smith. I joined the group just shy of 3 years ago now, initially as the Chief Financial Officer, and I took on the role of Chief Exec last year. And I'm joined in the room by Sam Vora, who is our Chief Financial Officer, joined the group on an interim basis in December, and was delighted that he's come on board on a permanent basis very recently. Before I kind of turn the pages and talk numbers and any more detail, I'm just going to do a little bit of scene setting, because I'm very conscious there will be a whole mixture of people in terms of the audience. So SURESERVE Group, the SURESERVE Group is primarily involved in social housing energy services. So the bulk of our clients are either local authorities or housing associations. We are not doing domestic property works. We are primarily saying that social housing energy services space. So what I hope you'll see over the next, the next few slides is a little bit of background about the numbers, but also a little bit of a flavour for the activities we do. The way I'd like you to think about this business is, this is a business that is all about regular recurring revenues. We are very resilient. COVID, for example, had a lot of impact on a lot of businesses, but for the majority of our business, it didn't, because the work we do is non-discretionary spend. The local authorities, the housing associations, have a responsibility to their tenants to deliver the services. So think of it in that way is the best way. And this is the 6th set of roadshows I've done now. And historically, I used to talk about a defensive stock, and almost in a slightly embarrassed way. Now I would much rather focus on the resilience that goes with it. And Sam will talk about our order book. So without further ado, I will click on to the next slide. So if I just headline the numbers for the year, and I won't steal Sam's thunder. So remember, this is the 6 months to the 31st of March 2022, as compared against the 6 months to March 21. There are some strong performance in here. Revenues are up 24%. The profit is up by more, up north of 40%. I'm particularly pleased to see that the EBITA margin has held at 4%. It is clearly a difficult and different macro environment, the one we have now, to the first 6 months of last year. And we'll talk a little bit more about headwinds in due course. So seeing first half performance holding those margins and being a little bit above gives me great pleasure. The other things I would touch on this slide is I would draw attention to our balance sheet strength, particularly in terms of net cash. So the net cash of 11.8 million at the end of March, that's after having paid out 3.3 million in cash for the acquisition of Core Energy that was made in December 2021. So the actual underlying cash would have been above 15 million. The final 2 bullet points on this slide are very much at the heart of what I've just described in terms of what the business is about and the way you should think about it. So we in the first half of this year, we won more than 100 million pounds of new wins, and that was more than 50% up on the previous year. A number of those new wins, you will have already seen RNS releases over the last few months, which have detailed out those significant wins that we've had in the first half of the year, and we're clearly delighted with that performance. The order book, and I'm going to let Sam talk about it in a little bit more detail, but our order book is now north of £500 million, and that really does give us the visibility of future revenues that I described earlier. Away from the numbers, as I sit here as Chief Exec, what's important to me? So we relaunched our strategy, or refreshed our strategy, in January of this year. So what we said to the market in January was we are absolutely now focused on social housing energy services. That is about 80% plus of our core activities. And in order to do that, we will need to look at growing both organically and by acquisition. And I'll come back and talk about that in a moment. What that also meant is two of our businesses, our fire and electrical business and our lift business, do not naturally fit with our longer term ambition. So we are looking to exit those businesses. Just to be very clear here, both of those businesses are trading very well. And I will only sell them at the right time, at the right price to the right buyer. But they do not fit our long-term strategic future. And indeed, I think both businesses would be served better being part of the broader industries in which they operate. That clearly, selling those businesses helps me in terms of cash. I will get cash in, which helps with acquisitions. So I'm just to come back to the acquisition piece. So in terms of an acquisition strategy, and again, we outlined it in January, but I'll just talk about it a little bit if I may. We are working with an M&A broker to identify acquisition opportunities. We have a very promising funnel of opportunity. And there's two types of acquisition you should think about. The first type of acquisition is to grow our share in gas. So at the moment, we have about 9% of the social housing gas market. 9% makes us the market leader, but we're absolutely looking to make acquisitions in that space. So you should think about that being looking at geographical gas businesses that we can look to buy for cash. And we are absolutely looking at those at the moment. And the second one is perhaps what I would call the more strategic type of acquisition, of which Core Energy, who we acquired in December 21, would be a good example. The UK is going to transition across from gas to renewables technology. Some of that has started already, probably baby steps, I would describe it as. Government have said no new gas boilers from January 2035. We can debate whether or not that's a realistic date, but that is the date that's there at the moment. What is not clear at the moment is whether the UK transitions to solar, hydrogen, heat pumps, battery storage, or another technology that we haven't particularly thought of at the moment. So those strategic acquisitions are much more about looking for what are those businesses in the renewable space that would be worth us as bolting on to what we have already. And Core Energy that I touched on, they very much look at solar, lighting, energy efficiency schemes. So you should think of those kind of organisations. From a governance perspective, I've mentioned Sam already. Sam, I was clearly the CFO and was double hatting for a period last year. Sam coming on board as the permanent CFO is great for us. He's got vast market experience, as well as AIM-listed background, and also has a lot of M&A experience, which is clearly helpful given what I've just described. We're also incredibly pleased a few weeks ago to announce a new non-executive director, a lady called Tanya Songini, who has joined us. She has extensive renewables market expertise and experience, not just in the UK, but in fact internationally. And she will bring a different dynamic to the board. And I'm very excited about her arrival. She will make a difference very quickly. From an operational standpoint, I've mentioned Core Energy acquisition. They've started very strongly. They're trading strongly. They're having to move to new premises because they've already outgrown the building they're in. And they're having to recruit at a rate of knots, just simply through the growth they've got. Why have they got that growth? The reason they look to sell their business, and I'm very conscious that the two owners are actually on this call, they had got to a point where they were really plateauing in terms of their growth plans, and they wanted to look for a group to acquire them who could really help them to grow. And I think what has been demonstrated in spades here is that they've been able to access framework opportunities that weren't there before, and they're winning work on the back of it. And Tom and Richard, the two directors, they've been a great addition to us, and they also bring an element of thought diversity to the group in terms of renewables. So delighted with that acquisition. ESG, I will happily answer questions on ESG. We haven't put a specific slide in, but sort of ESG topics that I would talk about at the moment. We have partnerships with the Armed Forces Covenant. We were awarded a silver award back end of last year for the work we do with the ex-services personnel. We have over 50 people, ex-services personnel, who've come into the group, and we're very keen to explore that partnership. Yesterday, I was very, very proud as CEO. We have an annual set of awards for our apprentices, our best apprentices. It's the first time we've been able to get together in person since 2019. So I was in Manchester yesterday with over 100 of our apprentices, talking to them about some of our results, but also very much talking about the importance of learning and development. Had a guest speaker and a whole award ceremony at the back end of the afternoon. And that they are the lifeblood of this business. I can sit here and say whatever I like, but the reality here is this is all about having apprentices coming through the doors. We have over 300 people in a group of 2,600 who are undertaking training, and about 130 of them are on actual apprenticeship contracts. I will shut up at that point and hand across to Sam.
Thank you, Peter, and good morning, everyone. So I'm going to take you through the performance of the social housing energy services business. So for those of you who are familiar with SURESERVE and have seen our results in the past, you would have seen that we previously reported under a 2-divisional basis of compliance and energy services. Once we refreshed and relaunched our strategy, which was announced in January, with 2 businesses up for disposal, the remaining 7 operating businesses that we have are now within the social housing energy services division. So we're now only reporting on a sort of 1 business basis. Within the appendix to the presentation are some historical data about the performance of the business on the old 2-divisional basis, but also showing what it is on the new social housing energy services basis. So at some time you can have a look at those and look at the revenue, the profitability, and the margins historically. So really for this business, I mean, in terms of financials, very, very pleasing performance for the first half of the year. 24% revenue growth, of which 22% was organic and 2% came from acquisitions, which is the Core Energy acquisition in December. And it was really that revenue growth which drove the improvement in operating profit, up 24% as well to 6.7%. But I'd say the most pleasing thing for us here is really that improvement in the margin from 5.2 to 5.3%. Clearly, the first half of the year is during the winter months, and the business does have a level of seasonality such that our margins are lower in our first half of the year, primarily because of the high level of reactive repairs, call outs, higher material spend, potentially higher subcontractor usage in that first half. So because the majority of our contractual revenue is sort of flatlined and straight line throughout the year, when you've got a higher cost spend in the first half, your margins are typically going to be lower than what we'd have in the second half in the summer months when, for example, a boiler is sort of turned off. So very, very, very pleased with that margin progression. But also a key feature of our contracts is really around the pricing of them. All of our contracts do have inflationary clauses within them, either based on RPI or CPI. So each year with our customers, which are mainly local authority or social housing associations, we do have that price protection, that margin protection in terms of annual price increases. But also considering in terms of who the nature of our customers are, which are very much what either public sector, being local authority, or more akin to public sector or not-for-profit organisations with the housing associations, where we are seeing an increase in input prices, as we've noticeably seen in the last several months, then we can have those commercially sensible conversations with them to look to recover some of that cost inflation and recover it through higher prices. And we've had some success through that over the first half of the year. I think looking at other elements from a materials perspective, we are one of the largest customers for social housing for boilers. We spend a significant amount of money with PTS and Wolsey to sort of large consumables, materials, and plumbing suppliers. And we have rebate levels in place, and we have a very good relationship with them so that we can have proper discussions around pricing and costs with them. From a fuel perspective, we do run a commercial vehicle fleet of about 1,800 vehicles. So clearly the fuel price has been a bit of a surprise to us in the first half of the year, particularly towards the end of January, start of February. But effectively our strategy, as we announced earlier this year, is to move to 100% EV fleet. Clearly there are issues around sourcing electric vehicles, but our ambition is to sort of get to that 100% by the end of 2025. And to put that into perspective, at September last year, our year end, we had about 50 vehicles, which is only about 3% of our fleet. At the end of March, we're about 6%, so we had 103 vehicles. We're expecting to be nearer 10% by this end of the financial year, but clearly, given the chip and processor shortage globally, it's a little bit more of a challenge sourcing electric vehicles. And really, I'll come back and talk about it in a little bit more detail, but contracts and order book is a key strength for the group. In the past, contract duration used to be typically 3 or 4 years. Now, effectively, what we've seen over the last year and a half is those contract durations pushing out to sort of 8 to 10 years. And when we talk about the contracts, these are firm contracts. These will convert to revenue. These are not access to just a framework agreement, but actually legally committed contractual orders with our customers. So, I mean, last year we announced a 10-year contract and a 5-year with a 5-year extension with the Guinness Partnership, and that was worth £140 million. And a couple of other examples are shown there on the slide, in excess of £20 million with Metropolitan Thames Valley Housing, albeit for only 4 years there, but a very substantial contract in itself. £17 million with the London Borough of Tower Hamlets, which is a 10-year contract, and then also another 10-year, £10 million contract with Southend Borough Council. You know, very pleasing to see on the gas side, but actually what's really of particular interest to myself and Peter are really what's happening on the energy efficiency and renewables side. Moray Council, our Scottish business, Everwarm, has been working with them, and that was a £3 million contract for solar PV, battery and air source heat pump installation. But really the next two are around our recent acquisition, Core Energy. And actually, we've been very pleasantly surprised with Core Energy, not just as a business and its performance, but also the thought leadership and that the two founders who are part of our business bring to the group, and their ability to really use their renewables knowledge and share that with the rest of the group for the greater benefit. So a couple of examples there are some good successes and good wins that have taken place. There was a £1.5 million design and installation of roof-mounted solar PVs at 25 schools with Dorset Council, and nearly £1 million of heating decarbonisation consultancy, lighting efficiency, and again roof-mounted solar PVs with Gloucestershire NHS Trust. You know, that business does work with NHS trusts and universities, and you know, I know that conversations do take place, particularly with certain NHS trusts, about how they transition away from the traditional gas boiler heating to air source heat pumps. I think I'll also just touch upon the group does have, it does have 2 joint ventures. One of them is sort of finished towards the end of the year, and we're now in a sort of post 12-month sort of warranty maintenance phase in that. That's a joint venture called Arbed, which is working with Welsh Government. But really the largest JV we have a 1/3 share of a company called Warmworks, which is a business based up in Scotland, and it was established to deliver the Warmer Homes Scotland programme for fuel poverty alleviation. So working with Scottish Government, and we're a 1/3 shareholder or partner with together with the Energy Savings Trust and also Changeworks, a Scottish charity. And that business itself has done very well, and our share of the profits has been increasing each year. And Warmworks itself acquired another company, Connected Response, at the back end of last year, and that business, Connected Response, is really involved in the diversifying the range of heating solutions that are available to homes which are in fuel poverty, and that really fits in very well with the strategy of Warmworks, which is very, very pleasing to see. Next slide, please. Just really touching upon the P&L accounts here. It's just a summary of it, but clearly revenue growth of 24% and profitability growth of 41%, as Peter mentioned before. Acquisition costs of 0.1 million related to the acquisition of core energy and the amortization of the intangibles, again related to the core energy acquisition. Net interest payable was down a little tick compared to the previous period, and that was really off the back of the refinancing of our banking facility, which we completed in December, and that gives us a certainty of funding from a very supportive banking partner who we have with NatWest through to January 2025. The interest on the lease liabilities ticked up a little bit, but that's really because we've increased the size of our vehicle fleet, which are all on leases. From a tax perspective, we expect our tax rate to be in line with the UK statutory rate of 19%. Clearly, that's going up from April next year to 25%. So there'll be a blended rate of 22% next year before the following financial year moves up to the 25%. But really, very, very pleasing to see EPS growth up 37% to 2.2p. And there was also a slight element of dilution because we did issue a number of shares in relation to the acquisition of Core Energy, which was half cash, half shares as an acquisition. From a segmental basis, this is just a bit of a summary of the earlier slides, but I think the key thing to touch upon here is just around those central costs. So this is the head office, the PLC, the centre, which did tick down a little bit year on year, and central costs do remain an area of focus for ourselves. We did have to make a few redundancies earlier in the period, just to sort of in line with our reorganised strategy and how we've sort of tackled the overall cost base looking at the centre. But really, it remains a key area of focus for us for the rest of the year and beyond. And then in terms of the balance sheet, it's a very strong balance sheet, and it's really dominated by the cash position. 11.8 million at the end of March, and that compares to 16.5 million at the end of September last year, our previous financial year. And that was, as Peter mentioned, that was after we acquired a company, part cash, part in shares. Working capital management is a real focus for us, and as a business as a whole, our cash cycle is significantly lower than 30 days. So that includes effectively our accrued income, the work that has been done but hasn't been invoiced, our receivables, and less our payables. And really operating in the environment that we do, and given who our customers are in terms of local authorities and social housing associations, once you invoice them and you submit all the paperwork with the invoice, you do get paid. The history of bad debts in this organisation is incredibly low, and there hasn't been a bad debt issue for many years. So it's a very good area to be operating in, and that really shows through tight working capital and a real discipline on cash collection. So we have very positive operating cash flow, and that sort of feeds through to a strong, healthy cash position. I mentioned before that we refinanced our banking facility, so we have a £5 million overdraft and a £15 million committed revolving credit facility with NatWest through to January 2025, and really, a combination of that banking facility and also the cash level. But when you combine that with a good share price, strong balance sheet, very strong results, it really gives us significant opportunity to fund our organic and inorganic growth strategies through cash, but also using equity should we need to. Next slide, please. And then really thinking about the order book. So order book grew by 50% to 512 million, and that's an incredible number, and all of that will convert to revenue. We have great visibility in terms of our order book. So as at the 31st of March, for the second half of the year, we have 96% of our revenue secured for the second half of the year, which is a great position to be in. But what's really important is the tail of that order book. 63% of the following year, FY23 revenue, is secured by the opening order book, and 43% for FY24. And if I think about where we were 12 months ago, when the tail of that order book, the 63% was only just over 50%, and the 43% was about a quarter. So in terms of the contract wins that we have, the 101 million of contract wins, but also the longer duration of the contracts. Now we're talking about 8 and 10-year contracts with our customers. It's really supporting the size of the order book, and it gives the board of directors and the executive management team tremendous confidence in future revenue visibility, earnings, and also cash generation, which really supports our inorganic and organic growth prospects. And over that, I'm going to pass back to Peter.
Thank you, Sam. So let me sum up, and then while Sam was talking, I've been trying to keep an eye on the questions as well. So there's some good questions. I want to make sure we have enough time to answer all of those. So what would I say in summary here? I said this is the 6th time I've presented to investors in my tenure here, and every time we presented, we've talked about revenue growth, we've talked about profitability growth. This is all a momentum story for me now, and I have no reason saying different to that. That's absolutely what's out there. Many of you will have looked at the analyst notes that are out there. So Shore Capital are our broker, our Nomad, and Alistair Stewart, who's the analyst who writes. He has held his position for what he's expecting for the year. N+1, Singer, and Peel Hunt, who also write on us, have both made the same, or taken the same view, I should say. So very pleased with that. We talked about the contract wins and extension. I'll come back to the question on contract lengths in a moment that I've seen. And to Sam's point, the order book, really does give us revenue visibility. And I think for me, I often describe that order book slide as being the most important slide in the deck. And the fact that those percentage numbers is going up, I've been going up year on year, tells you how confident we are in the future. We talked about Core Energy. It was an important acquisition. It was the first acquisition of what we hope will be, a number over the next few years. But the successful integration is just as important. The acquisition is nothing if you don't get it integrated, and we've successfully integrated. Very pleased with that. We are really clear on the growth strategy around social housing energy services. That has both organic growth rates that we would expect to be in excess of 10% compound annual growth, and then looking at the M&A funnel to make sure that we supplement that with acquisitions both in that gas space and the renewable space. I'll come back. I've seen a couple of questions on the businesses for sale. They are held for sale, but we will not make a decision in haste. It needs to be the right decision. And the fact that they're both trading strongly means there is no urgency to do it. The board, I've talked about the strengthening with Sam and with Tanya coming on board. So my kind of final thoughts on it, and then I'll go back to the questions, is yes, there are economic headwinds out there at the moment. We all know that from a macro perspective. We all know that closer to home in the UK in terms of around energy, utility companies, cost of living, all of the above apply. But, as Sam outlined, we have CPI and RPI inflationary clauses in all of our contracts. We have a number of clients who are absolutely open to commercial conversations outside of that. Clients do not want long-term contracts that have surprises for suppliers. So, there are conversations we had. You shouldn't think about this business as being quite as commercially cutthroat in terms of our client base as other businesses you may be familiar with, and we're working very hard on those mitigating actions that Sam talked about, and I'll come back to because there's a specific question. We're very confident in our outlook for the second half of the year, and we firmly believe that we're well placed to be at the forefront of the energy transition as the UK moves away from gas and moves to renewable technologies over the next 10-15 years. With that, I'll hand back to Mark and we'll do a Q&A if we may, please.
That's great, Peter. Thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be accessible via your Investor Meet Company dashboard, and we'll notify you by email when they're ready for your review. Peter, as you quite rightly pointed, you've received a number of questions from investors through today's call, and thank you firstly to all of those for submitting those questions. If I could just hand back to you, Peter, just to read out the questions and where appropriate, give a response, and I'll pick up from you at the end.
Yeah, of course. And I'll just take them sequentially. So Mark A asks, what's the process and timeline to winning new contracts, and what's the average length of these contracts? Do you retender annually? Okay, so Sam touched on it. If you'd asked me a year and a half ago, our average contract length was between 3 and 5 years. We have seen a real shift in that to contracts typically being 8 to 10 years. And the wins that Sam outlined earlier and a number that have gone out in RNS in recent months, they all tend to be 8 and 10 years. That we firmly believe that is local authorities and housing associations want certainty of supply. And actually, the fact that we're market leading in that, particularly in that gas space, means that clients are very happy to commit to the longer term. The question about the process is the local authority ones very much public procurement processes you would expect. And indeed, housing associations, although they're not public sector as such, it's almost a kind of quasi public procurement process as well. So how do we see those opportunities? We see them because they're in the public domain, and clearly we know the majority of the clients too. But the process is also different to what you might expect in more commercial, with more commercial clients. So typically the focus here will be more like 70% on quality and 30% on price. So we do not look to win on price. We never have. We look to win on quality, and we look to be, second or third on price. And when I talk about quality, that's giving the client real confidence and certainty that we can service every boiler in their housing stock every year. We can look after their lifts, their fire and electrical, whatever that activity might be. So quality is the more important metric than price. So do you re-tender annually? No, because of the nature of the contract. I mean, Sam mentioned the Guinness contract that we announced in August last year. So the headline was 10-year, 140 million contract. That after 5 years, there is a pause and reflect for both parties, but they would deem that a 10-year contract, as would we. So,
and I think just to add, in terms of our sort of winning rates and our retention rates, which is very important. Our win rates are about 2 and 3 overall as a group, and our retention rates is about 4 and 5, so about 80%, and that's remained static for the last 12-18 months.
Thanks, Sam. Matthew R asks, if you're the market leader with 9% of the gas market, it must be very fragmented. How will you look to get more market share, and is this a key focus? Great question. So let me try and put some numbers to this. The social housing gas market in the UK is worth about £1.2 billion per annum. So our 9% is 9% of that 1.2, and that's based on last year's full year numbers, just to give context. Yes, it is hugely fragmented. So how do we look for market share? I go back to what I was saying earlier about the kind of funnel. All of our gas MDs have very clear knowledge of the sector. They know who they compete with on a regular basis. So we have identified both the regular competition, but we've also identified a number of smaller regional players who potentially become interesting additions. I didn't mention it because it's actually the previous financial year, but in December 2020, for example, we acquired a business called Vinshire, and we had a particular desire to have a gas business in the Midlands. Sadly for them, happily for us, they had gone into administration. And we picked that business up from the administrator. They would be the example I would give us of a smaller regional player, but a natural bolt-on. So very much, yeah, we've got clarity of who's out there, and we need to identify the right ones who might be open to an acquisition. So hopefully that's answered Matthew's. Michael D, have you experienced any issue with your supply chain? I suspect that question came up actually before Sam was talking. But just to kind of, actually, Sam, do you want to reiterate sort of supply chain?
I think if you think about our cost base, and our largest cost base is our people cost. So no issues there about supply chain. There have been some skill shortages, around labour availability, but we've been working through that, and our staff turnover levels have remained very, very low, at sort of 5% level. Across many of the businesses. I mean, in terms of the supply chain from a materials perspective, we haven't really experienced anything of significance in the first half of the year. We've had conversations, and Peter wrote to the three main boiler manufacturers, Vaillant, Ideal, and Worcester Bosch, in the last couple of weeks, talking to them about not just pricing but also supply and certainty for a period of time, because clearly they are they're part of that supply chain and the manufacturing process. So there are, again, it comes back to that availability of things like microchips which go into boilers, but also into the heat pumps that go into a boiler as well. So they have seen limited issues. in terms of the supply chain for the next 6 to 12 months. But we have the availability and an option where in many of our contracts we can swap out from one boiler manufacturer to another. We have to have a conversation with the clients. But really, we haven't seen anything of significance, and there's nothing really in the next 6 or 12 months which is of concern to us. I think the biggest supply issue we've got is really around sourcing electric vehicles, just because of the demand for them.
Thanks, Sam. I mean, just to underline what Sam said, particularly in terms of the boiler manufacturers, we are the market leader, right? Market leader helps here. So it is not a coincidence that we are having fewer sourcing problems than some of the competition. There being no doubt that the market leader is helping us there. Those businesses are very, very keen to ensure supply for us. So, I'm very confident in our supply chain. Mark A asks, what do you look for when considering new acquisitions, and how would you look to fund them? Okay, again, we may have touched on this, went through. So I think if I talk about gas acquisitions, to the point I just made, there are two things to think about. One will be about geographies. So this will either be geographies where we have no presence or limited presence. So, for example, we have a very limited presence in the northeast of England and the southwest of England. So those are regional areas that we would like to have a presence. And likewise, there are some regions where we would just like to increase our market share. So I think when you think about gas, you should think about regions. We're confident that in terms of being able to bolt them into the group and achieve economies of scale, that's very doable. If we're talking about new acquisitions in the renewable space, obviously this is a bit more of a journey of discovery for us. But again, Sam and I both talked about Core Energy. One of the massive advantages, and Sam and I both talked about the thought leadership, is the guys at Core Energy know this renewables market. So they already have companies that they have worked with or indeed competed against who they think are of particular interest. So we have a number of renewable businesses that are already known to us, and then separately the broker is obviously doing more of what I would call a desktop exercise to identify. How do we fund? Again, I think Sam, obviously there's kind of a few bits to this. We clearly have decent cash in the bank. The 11, just shy of 12 million at the end of March. If you look at any of the analysts, they're expecting us to be 20 million plus at the end of September. I think that's realistic. If we sell the businesses that are available for disposal, and I'll come back to that question in a moment, there's clearly more cash. We then have the 5 million overdraft and the 15 million revolving credit facility that Sam outlined. So, funding we can do ourselves. If we found something of sufficient scale that we needed to look to do something different, we have a fantastic relationship with NatWest, who've supported us for a very long time and have been very clear with us that they would look to extend funding. So there's plenty of opportunity here. Right. Neil B, the gross profit actually declined by £1 million in first half this year versus last year as the gross margin fell. What are the reasons for this and the prospects? So I'm going to, Sam, do you want to talk about provider?
Yeah, so I mean, the gross profit clearly, you've got wage inflation, you do have material cost inflation, but not at significant levels, because most of our wage rises take place in October, which is before this current significant inflation spike took place. But even though it was about 3% on average across the group, there were examples, particularly in some of the businesses, where we had to give in excess of 10% to realign the salaries of some of our gas engineers. I think two features as to really that gross margin movement. One has been the fuel price. To put it into perspective, when you're running a 1,800 vehicle fleet, of which more than 90% is diesel, the average diesel price we paid in the first half of the previous year was £1.13 per litre. For the first half of this year we're reporting on, it was £1.47, so a 30% increase. And not only was a fuel price increase, but also the level of activity and volume had gone up. We drove more miles, because the previous year was impacted by COVID. So you've got a sort of fuel price element there, which directly feeds into that gross margin. And as you see now, we're now at about £1.80 per litre. So there's going to be more of a sort of gross margin impact in the second half of the year. But the other part is really around action that we took ourselves, and that's really within our smart metering business. So we have a company called Provider. It installs smart meters, so single fuel or dual fuel smart metering on behalf of the utility companies, and these are the larger utility companies, not the ones that were affected by the impact of the wholesale gas price last year, when a lot of the smaller players went bust. So our customers here are not domestic properties, but they are the three utility companies of Scottish Power, EDF, and Octopus Energy. So we took the decision, because of the level of demand that we're seeing from those customers, to significantly ramp up our headcount in that business by effectively taking on a significant number of people, putting them through a 10-week training program so that they are smart engineer accredited. And really that was an impact on the gross margin in the first half of the year. Clearly that will come back in the second half as they are on the tools and out in the vans installing smart metering. But in terms of the full year, we would expect the gross margin to be at similar levels to the prior year.
Thank you, Sam. Neil, I've got a whole sequence of Neil. Right, Neil, when do you expect to complete the two businesses for sale, and what might be the expected proceeds? Neil, apologies, I'm not going to answer the question on timeline. That would be completely inappropriate. We are in processes at different stages. In terms of expected proceeds, I don't mind talking about that. So those two businesses combined last year contributed about 2.7 million of EBITA. I would want in excess of 10, somewhere between sort of 10 and 14 million, to give you a broad sense of what I think would be acceptable to the board. Certainly, if I weren't, if it wasn't north of 10 million across the two businesses, I wouldn't even be recommending it to the board. So think of it as double digits. I think that's a reasonable range to give you. Neil, given the right now into question I haven't seen in advance, so I haven't scrolled down far. Given the dividend cut and the upcoming disposal proceeds, how soon do you think? Okay, I mean, obviously, we need to remember that the Core Energy acquisition was only in December, so it was in this financial year. I would very much like to make another acquisition that we can announce by January 2023 when we announce our full year results. But I'm not going to commit a date on it. It's more important to make the right acquisitions than make an acquisition for the sake of it. And it won't surprise you that over the course of this week, as particularly Sam and I've been talking to the larger institutional investors, they are very clear. Do not just make acquisitions for the sake of it. The market is challenging for everybody at the moment. So take your time, find the right ones. And say, we have got a very promising set of leads, but I'm not going to commit a timeline on those. Roger, who are the main competitors for the business, and what are your unique selling points? Main competitors, it really does depend which space you're in. So if you're in gas, I've probably answered it in terms of talking about potential acquisition targets. So it tends to be quite regional. I mean, if we're in the Northwest, the main competitors in the Northwest would be PH Jones in gas, who are part of British Gas, or Liberty Gas, who are a big significant player, particularly in the Northwest. So they would be two in the Northwest. If I come round, Sam and I are in Dartford today. If I come round more to the southeast and into East Anglia, you have people like Swale would be a good example, T Brown, Oakray, Robert Heath. They will all be, they will be a number of businesses, and then there will be some smaller ones that will be less familiar. So in the gas, it would be those. If you're talking in the renewables, it's so fragmented that you almost have to look at what the individual technology is to see who the competitors were. What's our USP on gas? Our USP here is all about, is all about experience, longevity, market leading position. Remember the client base of local authorities and housing associations, they want real certainty around who's delivering the work. So actually our USP, if I can even call it that, is our longevity and experience. In the renewables business, too early, we will get there. If I'm ever warm up in Scotland, the USP is they're the biggest, insulation and energy efficiency business, up in Scotland. They've got about 16% of the Scottish market around insulation. So again, I would see USP more about being scale. And by the way, not being complacent about that scale, continuing to look and grow. I have an incredibly strong leadership team around me. And so, I have market leading MDs, and that is a kind of a USP in its own right. Tom G asks, what does the pipeline look for new acquisitions and what are your expected timeframes? I probably touched on it. As I say, I'm not going to commit to timeframes. Clearly, I'll be disappointed if I get to January and I haven't got something to announce. But the pipeline is very healthy. I'm saying Sam's very much leading the M&A piece on this at the moment for us. There are a lot of businesses in this pipeline, and there's some really good business. We have started dialogue with a number of businesses. There's a lot of desktop research going on. There are a lot of those businesses, as I say, that are well known to our MDs already. So some of these conversations are more formal than others. So healthy is how I would describe it. Disappointed if I don't get one away by next January. I appreciate doing that. I've kind of committed myself to it, but that's okay. Neil asks, it looks like Shore Capital are forecasting EBITDA on a pre-IFRS 16 basis, while Peel Hunt is on a post-IFRS 16 basis. Please, can you give the depreciation of right of use assets for half one last year versus this?
So I mean, all of the information is actually in our RNS. So if you look at the financial statements of the RNS, that information is actually within there.
Okay, thanks, Sam. Right, Michael T. What are the prospects for a dividend? Okay, so we said back in January when we did our full year results, we wouldn't pay a dividend this year. That remains the position. If you think I'm going to announce an interim dividend, apologies, you're going to be sadly disappointed that we said we wouldn't pay one this year and we won't. What we will say now is exactly what we said in January, which is we will consider the dividend on an annual basis. So when we get to January 2023, the board will clearly look at cash in the bank, where we are with disposals, where we are with acquisitions, and make a decision on the dividend next year. So our position remains as we said in January. Alex M asks, an overdraft and an RCF, so a revolving. Sorry, let me do that again. Alex M, an overdraft and an RCF. Can you please describe the difference, Sam?
Yeah. So an overdraft is very much more a short-term funding line. So, when you might just need to dip into an overdraft because of timing difference, you may pay suppliers or, may pay your payroll or something, and your cash balance may dip into a short-term credit line, effectively. An RCF is very much more a longer-term debt facility. So, whereas both facilities are committed by the bank, the revolving credit facility is a much longer-term debt line that you have, for us in place for 3 years, and it's very much more overdraft short term, RCF long term. You would never acquire a business, for example, just using an overdraft. You very much more look at that sort of longer term facility.
Thank you, Sam. That's all the questions we've got. Mark, if I can hand back to you, please.
Perfect. Thank you. Brilliant timing. Thank you to you both for your time and your responses. And thank you once again to everybody that submitted questions today. Peter, to me, I know that investor feedback is important to you guys, and I'll shortly redirect investors to provide you with their thoughts and expectations. But I wondered if it may just ask you for a few closing comments before I redirect the investors.
Yeah, thank you, Mark. I mean, I kind of go back to what I said on the summary and outlook slide. This is a group that has posted 3 years of improving trading, and I see no reason for that not to continue this year. I'm very confident in the outlook for 2022. That order book gives me confidence beyond 2022 as well. So, this is a business that is all around regular recurring revenues. It's resilient. These are non-discretionary spends. We didn't talk about the UK political agenda. We could have done. The UK political agenda is clearly about a transition in energy that needs to take place from gas to renewables in due course. And I see SURESERVE as very much being invested in both sides of that. We have real genuine strength in gas and increasing strength in renewables, and having the client base and the workforce and the wherewithal to understand that transition across from gas to renewables. I absolutely see us as being the forefront of the energy transition in the UK.
That's great, Peter. Samir, thank you very much indeed for that and for updating investors this morning. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SURESERVE Group PLC, we'd like to thank you for attending this morning's presentation, and may I wish you all a very pleasant morning.